Gold has been on its record-breaking run, and the Bank of England, the venerable old lady of Threadneedle Street, is warning that tech stocks may be overvalued and may contribute to financial instability. Where should you look for opportunities in other pockets of the market? We're joined by Lesley Marks, Chief Investment Officer at Mackenzie Investments. Lesley, great to see you. We've all heard about the Mag 7 ad nauseum. Are you seeing opportunities in other areas of the market?
Well, great to be here with you, Andy, this morning and to talk about what's happening in the market, because time and time again, I keep hearing people make references to there being an equity bubble, and this time echoing the 99-2000 tech boom. And I think in some areas of the market are certainly frothy, and we've seen so much focus on a couple of those areas, AI in particular, and any company that has an announcement AI related seems to get a lot of attention and have a surge in their share price. But it's a big market out there, and it's a big world out there. And when we look into, sort of beneath the headlines, there's a couple points that I would make which highlight the opportunities that exist in the market. The first one is valuation. While valuations in aggregate for the S&P 500 may look extended versus history, I think there's a lot of justification related to the operating margins or net margins that we're seeing from companies, which are much higher right now than we have seen in history. And so that somewhat justifies the higher valuation. The second point I would make, when you look at markets around the world and you look at the price upward that we've seen in global equity markets, the U.S. has actually been mostly accounted for. The majority of the move has been accounted for by earnings growth. So that also gives me comfort overall. Other markets around the world have actually seen more of a valuation catch-up because there has been so much focus on U.S. equities. So it's been nice to see the spread around the world of the enthusiasm for equities. And so to your question about opportunities and where we see opportunities, I would say, obviously AI is a very strong fundamental opportunity with a very big tailwind, but there's so much attention focus there. We would start to look at other areas of the economy that are going to benefit from the productivity enhancements that AI will bring, benefit from a CapEx cycle that is reignited in the United States. So examples of that would be industrials, of course, utilities in the context of greater demand for electricity. So those would be some areas where we think there's opportunity. The last thing I would say is, we should be looking around the world and watching what's happening where CapEx is being spent in Europe and the opportunity that has for, a fiscal pulse for European equities, and now more recently Asian equities are also looking very interesting.
So you say industrial companies, just simply companies that sell electrical equipment, for example, not necessarily electrical generators.
I think, broadly speaking, in industrial companies tend to have a very large CapEx requirement as part of their business model. And we think with the One Big Beautiful Bill and all of the tax incentives that come with capital spending, including additional capital spending that's going to happen in the United States through this onshoring trend, I think that you will see a huge benefit to areas like the industrial sector.
Talk to us about Europe. France is something of a cloud over that part of the world with their big government debt and their inability, it seems, to rein in spending. But generally, you are seeing opportunities in Europe?
Well, I think that the opportunity in Europe overall is, not necessarily France specific, but I would say there's a lot of opportunity in other areas, and, particularly in defense. And I think that momentum or that interest in spending more on defense around the world as we deglobalize will continue to be important. So you've got a defense tailwind, you've got extra fiscal spend coming out of Germany, as we've seen, and overall in the European Union. And Europe has been an area of the market where people have been able to ignore it as they've been so focused on the Mag 7 in the United States. And now people are waking up to the opportunities, things like the pharmaceutical sector as well. That's a big sector in Europe. And so there's other areas of the world that we think there will be dominant sectors that will start to perform that people have been able to ignore for a very long time.
And you think that the Fed is likely to cut at least once more?
Well, I'm glad that you actually mentioned the Fed, because that's another area that's extremely topical right now with the government shutdown. And the concern is that without proper BLS data, the Fed will be flying blind and won't be able to make decisions. But I do think that given that the Fed only cut by 25 basis points at their last meeting, that's not a material policy move, that they will be motivated based on the information that they have today to do another 25 basis point cut. It is clear that the U.S. labor market is on a softening trend, and that will continue to support easing of policy to support the U.S. economy, despite some of the noise that we've seen around the economy and a little bit of, stubborn inflation in the economy. I think the labor market is really the story, and that continues to support that move.
What about, we've heard about this for more than a year now, this divergence where lower income consumers in the United States are hurting. Does that, are hurting more? Does that affect your investment strategy at all?
Well, that's a really interesting point, because what we have seen and what we would have expected to see right now is weakness of the U.S. consumer. The U.S. consumer represents about 70% of the U.S. economy. And so many will point to that as an indication that the consumer should be rolling over here. Times are getting more difficult. Things are getting more expensive, particularly with tariffs. What we've seen is something that is a little bit different from the expectation, which is that the stratification between the wealth effect and how that's impacting the wealthier segment of the U.S. economy is more than compensating from the slowdown in spending from the lower end of the U.S. economy. So, there's two sides to that coin. One says that, yes, most consumers are worse off right now, even though the aggregate number or the consumer numbers, consumer spending numbers, retail sales, et cetera, are still robust. So I think that we should be really mindful of that. And that's a great example where looking at the headline number, consumer spending, retail spending, doesn't tell the full story.
Lesley, thank you very much indeed.
Thank you, Andy.
Lesley Marks, Chief Investment Officer at Mackenzie Investments.